Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Tuesday morning, we're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Rima and Nigel. Guys, good morning.
Hi, morning.
Hi, good morning. Well, yesterday was sort of a tentative kind of session, but today the cues are looking a lot more optimistic.
A lot better.
A lot better, yeah.
And precious metals and commodities, all the rage.
Absolutely. Metals continue to shine. One wonders when that demand will get hit because of the kind of rise that we've seen in pricing.
Yeah.
But I guess for the time being, it's ride metals with momentum, and that seems to be playing out.
Riding the tiger.
Indeed.
Anyway, let's just take it from the top, right? And commodities is going to be a big part of it, what we're going to discuss here over the next 2.5 hours or so. I mean, it's a relatively straightforward session that we're reporting to you this morning. Actually, it's a repeat of what we've had for the bulk of 2025, when U.S. markets kept making newer highs. I think there were about 40 new all-time highs in 25. So S&P 0.6% higher, the Nasdaq about 0.69 higher. You had a bit of pressure as far as yields go, 4 basis points lower, but the absolute levels are still around 4.1, 4.15. And I think, the 4 basis point came through as ISM manufacturing index hit the lowest level since October 2024. It's not as if it's plunged or anything, but it's just, a data point. Oil prices went up 2%. Now, eventually, the consensus view is that, as more Venezuelan oil supply comes to the market, but that'll take time. Oil prices, it'll put substantially more oil in the market, which means lower prices. But for now, as we look at last night's session, 62 on Brent. By the way, Chevron, which is the only U.S. oil company in Venezuela, and which has been basically, by the way, allowed back, was up about 5.5%. But that's a very company-specific fact that we're looking at. But a bunch of other U.S. Oil companies were also higher. Chevron, of course, is the biggest and the one which is actually there. Now, metals, as I said, big moves. Copper trading above $13,000. Silver prices 7%. Gold prices 3.5%. So this is, just an absolutely gangbuster kind of move that we've had through 25. 65% on gold in 25, 150, 160% on silver in 25, and you start the year like this. What can you say? In terms of President Trump's activity on social media, etc., he posted on X and he basically said that U.S. will soon be receiving more than $600 billion in tariffs. Remember, if you remember, in 2000, around the Liberation Day period, which is April of 25, estimates were that the U.S. essentially will collect about $350 billion in tariff-related revenues. And President Trump now saying that $600 billion is the revenue they will intake on account of tariffs. Now, I'll come to the market here. Nifty sold off, but that's just the Nifty. Broader market, broader volume/price action looked much better. Actually, it was not bad at all. Even though numerically market breadth looked pretty negative, but you just count what was down on volumes and what was up on volumes, and I think you've got to give it to the bulls, at least in the broader mid and small cap space. Third quarter business updates continue to pour in. Axis Bank has put out an update and look better. Trend perhaps maybe slightly sideways. L&T Finance looks strong, and so much more, which we will discuss in our top 10 segment in a bit from now. I'll just put out the 20-day moving averages. Not very much by way of change from yesterday. 26,013. We're still 150, actually almost 200 points away on the Nifty from the 20-day. For the Nifty Bank, that level is at about 59,290. Remember, bulk of Asia has started 26 on a pretty strong note. This is the time of this year, early January, when markets generally trade pretty well. We'll just have to see if India will be part of the mix this time around, because 25, we were not part of the mix. We were huge underperformers by a mile compared to most global markets. And I'm not even talking about the top performing markets like Korea, etc., which went up massively. GIFT Nifty up on your screen, 60-odd points higher is the implied open. Nigel has walked across to the wall with the F&O positioning and what the data shows. Nigel, over to you.
Well, Prashant, just taking a cue from what you said, in yesterday's trading session, though we ended in the red, it wasn't such a bad trading session. And one fact on the Nifty and the Nifty Bank is we made a higher high and a higher low. Normally you like that, and that's what makes my bias leaning more towards the positive side for the remainder of this month itself. Getting to the flows, well, yesterday the institutions were net buyers. The FI participation is gradually picking up. They were mild sellers, but very, very mildly so, though the participation will gradually pick up as the course of the week does progress. What did the FIs do on index futures? Well, there was some covering of some short positions, but clearly on stock futures, there was unwinding of long positions as we saw, and some shorts getting into the system. And post this move that we saw yesterday, well, the long-short ratio for the FIs on index futures doesn't change much. Shorts hold at around 89%. Moving to what they did then in the option side of things, well, yesterday they actually wrote calls and they unwound some of those puts that were written earlier. So, that's the kind of move that we saw. Aggressive call writing was back into play. Remember, the contract expires today because today is Tuesday, which is the weekly expiry. And you had the 26,300 call, 26,250 call. Well, there was aggressive writing that we saw on both those two strikes, and the premium has come down to around 25 to around 40 rupees. So just looking at the options data, you'll get your levels, and I'll get to that in just a bit. But one point that we made yesterday is the PCR is moving towards the upper end of the range. And when the PCR moves to the upper end of the range of around 1.5, 1.6, that's when you see some kind of cooling off in the market or maybe some kind of consolidation. I think that played out yesterday, and the PCR has come back down to around that 1 odd mark. So getting to the levels, going by the options data, this 26,325 to around 26,375, that's going to be the important mark that you're looking at. The 26,375 is the high that we saw yesterday. So that's going to be the important mark that you're going to be looking at. That's the range you're looking at on the upside just for the day. On the downside, for the next few trading sessions, where the 20 DMA is at, where the 50 DMA is at around the 25,950 to around 26,000, that's going to be the important mark. The Nifty Bank had a bit of an off day yesterday, primarily because HDFC Bank did come in for some profit taking. But as long as it holds above that 20 DMA, you'll still have to say that this one is good for more. So that's the important mark, close to around 500 points away from the 20 DMA. The stock that we highlighted in the final hour of trade yesterday was Sammaan Capital. There's a possibility it goes in the FNO ban is what we said. And by the end of the day, well, that was confirmed because that one's come back into the FNO ban. So we'll keep an eye out on Sammaan Capital as well.
Thank you very much for that. So Sammaan Capital is the new addition to the FNO ban, while SAIL continues to remain in the ban. 3 things to watch today. 1, as Nigel said, it's the Nifty weekly contracts expiry. 2, GM Breweries comes out with their Q3 earnings. And 3, on the IEX market coupling case, Aptel's next hearing is today. So these 3 things on the tap. Let's tell you the equity calls that we've got this morning. It's Vikas Jain of CLSA who says reduced relative premium to peer markets after India's record underperformance in 2025 should improve the acceptance of India as a portfolio hedge for foreign investors against global risk from consolidation in the AI bull market or an unwinding in the yen carry trade. But he argues that India's extended absolute valuation could keep the absolute returns muted yet again in 2026. He says this year, India may also lack new policy news, but this depends on the benefits from the announcements already made in 2025. What does he like? He favors consumption, rate-sensitive and IT segments, and they're boosting their consumption exposure by adding Eternal and Avenue Supermarts to their India-focused portfolio, and they're exiting Reliance and Nestle. All right, let's get in Matt Orton, the chief market strategist at Raymond James Investment, on the show now. Matt, thank you very much for joining in. U.S. markets completely shrugging off the geopolitical headlines coming out of Venezuela. To be fair, it doesn't affect the theme which is dominating the U.S. trade, that is AI. That still continues to remain intact. But as we begin 2026, give us the big calls that you're taking on the U.S., on India, and even India's position in the emerging markets.
Absolutely. Well, good morning, Rima, and a very happy new year to all of you. And I think the U.S. looks poised to continue to grow, as do all global markets. I'm quite optimistic on where we go in 2026. And while I like artificial intelligence, we've talked about this over the past year, my enthusiasm and my belief that we were not in an AI bubble, I do think 2026 is going to be a year of differentiation and more of a show me year. It's going to be very important, especially as we head into earnings season, given how much so many of these AI companies have moved, that the higher quality names that are not seeing deceleration or facing that law of large numbers, those are going to be the winners in the AI trade. And those who are not able to continue to push EPS growth higher, I think they're going to be challenged given the strong performance they've had. So When you extend that to a global perspective, I think leaning into cyclicality is a winning play for 2026 in the US. That means leaning into financials and industrials, even those associated with data center buildouts, but also those just based around manufacturing and beneficiaries of fiscal policy. In emerging markets in Europe, I think it's a similar trade. Leaning into cyclicality with respect to financials, I think continues to look very, very attractive. In India, same thing. HDFC continues to be my top overweight in the financial space. ICICI looks like it's starting to pick up a little bit too, and I think adding a little bit more there, especially heading into what should be a good earnings season, I think looks attractive. And the rest of Asia as well. I think there's a lot of opportunities to lean into that trade and also use downside opportunistically because there's going to be increased volatility given where geopolitics is, given where valuations are. So you don't need to chase the market as an investor. Let it come to you, but be prepared to put money to work because I think the fundamentals support continued upside.
In India, IT services, for example, Matt, good morning and Happy New Year, have been actually the two sectors, real estate and IT services, which are, double-digit down in 25. IT, as the conversation moves away from the infrastructure companies and the AI to the adopters, you think there's underperformance aside. Perhaps is a necessary condition for outperformance. But do you think, the ability of IT companies to sort of play into the theme of adoption, to cut costs, to use AI, enables them to do well this year?
Prashant, that's a really interesting point, and it's one I've been spending a lot more time discussing with clients and doing a lot of fundamental research on because I do think this is going to be the year of AI users as well as the AI enablers. And I think companies that are able to integrate AI to preserve their margins in the face of, I'd say, more persistent inflationary pressures, I think that's going to be a really important theme, not only this year, but in the next few years to come. And so when you look at Indian IT services, it's been an awful place to be over the past year, but you're starting to see a change of hearts. And I don't know whether that's because some of the charts are just so washed out that investors are trying to dip their toes in. But you look at some companies like Tech Mahindra, where the CEOs put new plans in place, even Infosys, given its global exposure, especially to asset managers who are benefiting in this environment, you're starting to see the outlooks change and turn a little bit more optimistic. And so I have my eye on the space. I'm not quite ready to go all in, but I am looking at dipping my toe because things are so cheap there. I think there could be opportunities, but again, it's a show me market. You have to prove yourself before I think investors are going to put more money to work.
All right, Matt, good morning and wishing you a cracker of a year in 2026. I recall when we chatted last, you were looking at some of these companies, Swiggy, a case in point. I'm sure they had a rocking new year because, deliveries are very, very high. There's a bit of a conflict going on as well on ground out here. But what's your view? These stocks have come off the top, Swiggy, Eternal. Have you got into them?
Yeah, so Swiggy is a name I own. Eternal is a name I have owned for a while. We talked about Apple AI as well. And I think when you look at all of these, I'll call them more, higher beta names, but especially the Swiggy Eternal that are related to the consumer. When I look at the names, Swiggy in particular, there's a lot of ground competition for sure, but that can't last in perpetuity. There's only so much cash these companies can burn. And what I like about Swiggy is that it has shored up its credit lines. It has money it can put to work to invest in higher value propositions. You're seeing returns from some of its cart enhancements that it's made. So I do think we're going to see a little bit of a turn, and hopefully the GST reforms really start to positively impact consumption as well. And so I like being exposed to the Indian consumer, and I think Swiggy looks fairly cheap. It's had a rough go in 2025, and I think it's set up to do well looking into Q1, Q2 in 26.
Matt, the other big talking point are the monster rallies that we continue to see in base metals, not just precious metals, which had a banner year last year, but look at copper, look at aluminium, platinum, going through the roof. What are the implications for global equity markets with this kind of a rise?
is bullish, Rima. I think the moves in base metals is certainly a signal back to that cyclical element we talked about at the beginning. I think it highlights that global growth remains resilient. So I take that as a very positive signal, while maybe some of the moves in silver, for example, which does have industrial purposes, might be a little bit extended. When I look at the moves in copper in particular, I'm very enthusiastic about copper and copper miners moving forward, because copper isn't just used for very, call it CapEx heavy areas. It's also used in data centers. It's used in chips. It's used in more EVs that China continues to invest in. And so I think there's a lot of use cases for it, along with significant underinvestment on the part of the miners. So you actually have increasing demand that's outstripping the increase in supply that we have. So I think copper looks like a very constructive market. And I think that's the story for some of these base metals going forward. So I do think that's an area to look for, maybe a positive surprise in 2026 across the commodity complex and other miners outside of the gold miners.
Matt, we'll leave it there. Thank you very much for joining us. Good speaking with you, and thank you for joining us here. Happy 26, and I hope you continue to do well. We'll take a quick commercial break here. What we're going to do is get you a quick snapshot view of what's coming up here. And the interviews and the chats. So 8:35, management of CSB Bank stocks done very well, especially yesterday, and of course, over the last few years, really. So third quarter business update, and we'll talk to Pralay Mondal on that. 9:20, Venugopal Gare of Bernstein is the market master of the day. He's got some interesting opinions. 9:35, the management of Oil India has talked to us on the company's outlook for 26 and more. And we put the spotlight on the cement sector with Goldman Sachs' Pulkit Patni at 9:45 a.m. Towards the end of the program, Lata in conversation with Sunil Singhania, founder and fund manager at Abacus, on what to expect from markets in 26.
Time to slip into a quick break. We've got a lot of stock-specific action to track for you. We get to that in just a bit in our special Top 10 segment. We're looking at Kotak Mahindra Bank, Axis Bank, L&T Finance, Adani Ports, IEX, Dabur and SAIL. They'll be reacting to positive news flow, while we have Trent, IndusInd Bank and Tata Motors PV, which will be reacting to negative news flow. Take that break, get into further detail on all of these names.
Welcome back. You're watching Bazaar Morning Call. It's time now to tell you the stocks that you need to have on your radar. This Tuesday morning, our entire research team is standing by with CNBC-TV18's list of top stocks for the day. Good morning, everyone. Gaurav, again, another busy day for you. Lots of quarterly updates coming through from the banks.
Yes. If you look at banking updates, first let's talk about Kotak Mahindra Bank, because the growth has been phenomenal once again. The growth has been at around 16% on a year-on-year basis. Remember, this was the number in the last quarter as well. And when it comes to deposit, there also we saw a growth of around 14.6%. Now, CASA growth, that remained flat. Remember, last quarter was the quarter when we saw CASA growing at 7% on a sequential basis. But in this quarter specifically, on a sequential basis at least, CASA growth has remained flat. But at the same time, what we should watch out for is that the segments which are actually leading this growth, and second is that the NIMs for the quarter. Now we will get only during the quarterly results, but for now, good set of numbers in terms of pre-quarterly updates from bank. Apart from that, Axis Bank, now this bank came up with the quarterly updates, and if you look at the growth, loan book growth is at around 14%. Now for Axis, this is very important, and the reason being that if you look at the trajectory of Axis, for the last few quarters, we have seen Axis Bank actually struggling with the growth. Last quarter, we saw Axis Bank actually got into double-digit loan book growth, and the 14% growth trajectory is something that we had seen back in first quarter of FY25 and days before that. So this is actually the first time when Axis Bank is reporting 14% plus growth after first quarter of FY25. Other than that, deposit growth, that also remained healthy at 15%. Another thing to highlight is that throughout this pre-quarterly updates, we have seen actually banks' advances growth was higher than the deposits growth for most of the banks. But for Axis Bank, deposit growth is higher than the advances growth. So that is also something that we should highlight. So these were some of the bank updates. And on the back of that, Axis Bank also is likely to open in green today.
Okay. All right, Gaurav, thanks a lot for that. But you've got a few more updates, I believe, that you're tracking today. IndusInd Bank and L&T Finance as well.
Well, as if you look at IndusInd Bank, we are seeing some kind of decline in the loan book growth. Actually, the loan book declined almost by 13% on a year-on-year basis, and this, in fact, this also reflects into 2% decline on the sequential basis. When it comes to deposits, deposits also degrew almost by 4% on a year-on-year basis. So basically, we saw actually the balance sheet shrinking on a year-on-year basis for IndusInd Bank. So that is something which is negative for the bank, given that we are, or rather, all the investors are expecting some kind of pushback and banks' asset and advances to go up. But it seems that third quarter at least is not that quarter where will we see the growth, at least in terms of advances. Apart from that, L&D Finance. Now, if you look at the quarterly updates, they look very much strong for the company, and the reason being that retail loan disbursement, now that has increased almost by 40% on a year-on-year basis, and also this reflects 20% growth sequentially. When it comes to retail loan book, that increased almost by 21%. Remember, actually company has given a target of more than 25% growth in FY26. Last quarter, if we see the growth, it was at 18%. This quarter, it is at 21%, and the street is expecting around 20% growth. So definitely it is higher than the street's expectation. Specifically, if you look at gold segment, now that is also growing because gold loan disbursements, they came in at around 1400 crores versus what it was at 983 crores. Remember, this was a business that they had acquired in the in fourth quarter of FY25, and this is also showing some kind of growth. So all in all, a very good set of numbers from L&D Finance in this quarter.
Thank you very much for that. So three positives: Kotak, Axis and L&T Finance. IndusInd Bank, though, has had a soft quarter. Vivek is now joining in with more on Adani Ports and IEX.
Well, that's right. You know, December monthly update as well as a Q3 update coming in for both Adani Ports as well as IEX. Adani Ports, December 2025, the cargo handled by the company went up almost 9% on a year-on-year basis at 41.9 billion metric tons. December 2025, the container volumes actually aided the growth, up almost 18%, and the logistics volumes was largely flat. Now, talking about YTD FY26, the company has handled close to 367.3 million metric tons of total cargo, implying 11% year-on-year growth when you're comparing the 9 months of FY26 to last year. Just an alert, this is compares against the guidance that the company has given for FY26 cargo volume growth that is expected to be in the range of 545 to 555 million metric tons, which includes the NQXT Australia acquisition as well. Now coming to IEX, remember, apart from the operational update, today is an important day given the fact that at Aptel today there will be another hearing regarding the market coupling case, and any development there will be material as far as IEX is concerned. Now talking about the Q3 FY26 update, almost 34.8 billion units of electricity was traded. Volume actually saw 11.9% year-on-year growth. But this is despite the fact that the day-ahead market, one of the key markets for IEX, actually degrew 2.8% for this particular quarter. For the month of December, total volumes went up 2.8%, but the DAM segment volumes fell 11.6%. Internal slightly soft, but this could be overshadowed by the news that could come out of Aptel today.
And we'll talk more about that news, that Aptel thing, which is coming up today in a little bit from now. Thanks very much, Vivek, for that. Tata Motors passenger vehicle is the next one we have on our radar. Sud is here with details. Good morning.
Morning, Prashant. So Tata Motors passenger vehicle has given the update for JLR, and this is for quarter 3 of FY26. And as expected, it's a weak update as far as the volume is concerned. If you talk about the wholesales, there the drop is more than 46%. If you talk about retail, there is a drop of almost 25%. And for whole year, that is 2025, wholesale volumes have fallen by more than 26%. And the drop is seen across the markets. And major two reasons why there is a big drop. First, there was a production stoppage because of cyber incidents that company had reported in September of 2025, and after that production got to normalcy only by mid of November. And the second, the planned wind down of legacy Jaguar, that is also impacting the total volumes. As far as the major contribution is concerned, it came from three major models, and those are Range Rover Sport and Defender, and these three together have contributed more than 75% to total wholesale volumes, and that is up almost 400 basis points year-on-year and down 240 basis points on a sequential basis. I'm going with mild red because of the recent underperformance on the stock, and also there is an improvement as far as the India passenger vehicle business is concerned.
Okay, all right. Thanks a lot for that, sir. Hopping across to Mangalam, he's here to tell us about Trent. Mangalam?
Well, I'm going with mild red on Trent this time around as well, because now the street seems to be, adjusting itself to a lower growth scenario for Trent. They've given their third quarter update where the revenue has grown 17%, 16.9% to be precise, close to around 5,200 crores. And remember, this is a number that they've netted off GST, because had it been for the GST cuts, then the realizations would have been lower, similar to something that we saw in the case of Avenue Supermarts yesterday. But similar to, again, what we saw in Avenue Supermarts, the store addition was a positive. So they've opened 17 Westside stores and 48 Zudio stores during the quarter. And if you equate the number of stores that they've opened between last year and now, it so appears that maybe the revenue growth is led entirely by stores, and there is a decline in same-store sales growth, and at the same time there is a decline in sales per square foot also. And this trend has been on the declining side. You look at the first quarter, where the revenues grew 19%, second and third quarter the revenues growing 17%. No meaningful pickup in growth out here. This despite the management saying that on a long-term basis, they are looking at between 20 to 25% CAGR. And the last 3 quarters, these numbers have actually disappointed what the management had guided for as well. The only reason I'm going with mild red and not a bigger red is because the stock has been an underperformer in all of 2025. After doubling in 2024, it's fallen about 40%. So a bit of the slowdown is in the price, but how much, we don't know. As of now, going with mild red.
Okay, all right, Mangalam, thanks a lot for that. Well, I'm looking at SAIL, and the stock has done very, very well of late. Yesterday as well, it ended at the high point of the day. They put out their update for the month of December, and it looks quite good. They say that the sales volume number is up by close to around 37% on a year-on-year basis for December, and they've recorded the highest ever December sales. They go on to point out that they've seen a surge across various categories. Focusing on April to December, the sales number that they've disclosed is up close to around 17% on a year-on-year basis. The management also adds that export volumes also recorded significant growth. We'll have to get the kind of contribution that's coming out there, smaller part of their business, but growth. So going with a tinge of green on this particular one as well. Going back to Mangalam. Mangalam, what about Dabur?
But Dabur is mild green. The reason why I say that is because, consolidated revenue growth is picking up, seen in mid-single digits. The EBITDA and net profit continue to grow ahead of estimates. The stock ended at the low point yesterday. So, the street was anticipating mid-single digit sort of revenue growth. But EBITDA and profits growing ahead of that is a positive, which means there is margin expansion. Consumer sentiment, the company said, improved in urban and rural areas. Rural still outperformed urban, which is better for Dabur because they have a higher share of revenue coming in from rural than all the other FMCG players. Home and personal care business, that grew in double digits. That's a positive. Healthcare, low single-digit growth, but that's a sequential improvement. The only reason why the business was impacted was because of the beverages portfolio, which got impacted understandably by adverse weather. So to that extent, I'll also look at Varun Beverages this time around because their portfolio could also be impacted by heavier than expected winter. But for Dabur, it is a positive. A mild green is what I expect on the stock today.
Thank you very much for that. Let's quickly recap then of the top stocks then. Stocks with positive news flow are the banks, the big large banks, Kotak Mahindra Bank, Axis Bank, L&T Finance, Adani Ports, IEX, Dabur and SAIL. Stocks with negative news flow are Trent, where Mangalam says it's going to be a mild red, Innocent Bank and Tata Motors. Well, moving on to the other important story that we'd like to highlight, Reliance Industries has clarified and denied the Bloomberg report, which claims the 3 vessels laden with Russian oil heading for Jamnagar refinery. The company's statement reads, and I quote, "A news report in Bloomberg claiming the 3 vessels laden with Russian oil are heading for Reliance Industries' Jamnagar refinery is blatantly untrue. Reliance Industries Jamnagar refinery has not received any cargo of Russian oil at its refinery in the past 3 weeks approximately and is not expecting any Russian crude oil deliveries in the month of January." The company goes on to say, "We are deeply pained that those claiming to be at the forefront of fair journalism chose to ignore the denial by Reliance of buying any Russian oil to be delivered in January and published a wrong report tarnishing the image of the company." End of quote. Well, let's move on then.
Just a quick word, Rima. It's an important clarification. I mean, because it's not just about Reliance, right? I mean, it's essentially about tariffs and all
Flouting
of that,
it,
flouting it, etc. So, strong denial, and we don't usually see this kind of thing coming through. But I think perhaps the company felt it needed to be said and loudly for everyone's consumption. So, it's a very, very closely watched thing. The amount of, we had HPCL, for example, yesterday with us, and we asked them how much of what's the mix of oil, etc. It's come down very, very dramatically. So this report certainly, going against that, and that strong sort of denial and clarification from Reliance Industries. Well, Manisha is here with a quick roundup of all that is happening in commodities, and a lot is base metals, Precious metals, Marisha, what's top of the list? Hard to pick.
Oh, thank you for that. Well, it's not too much of a movement that we've seen in the crude oil prices, but it is metals, the tangible commodities, which really seem to be doing quite well as January has begun. So copper, I want to start with that one, has hit a record highs. There are concerns of potential U.S. tariffs, but for copper, it also is about strike at Chile's mine, which is adding premium to prices. Not just copper, you have aluminum trading at a 3-year highs. You have nickel prices trading at a 1-year highs. Iron ore, which closed 2025 on a negative note, has started 2026 on a very positive footing there. And then you have zinc prices trading at a 14-month high. Silver continues to shine bright. We saw 150% of gains in the previous year, and silver has gained 10% already in 2026. The overnight gains for silver have been to the tune of 5.5% there. So very strong gains continuing into the market there. A final word on the crude oil prices, which is quite volatile. The investors still are assessing impact of U.S. action towards Venezuela, but it really is about surplus of 2.5 million barrels that we are dealing with in this year. And then Saudi Arabia cutting selling prices for its Asian consumers for a third straight month tells you that the demand is not so strong and the prices are taking pressure because of that.
All right, Marisha, thank you very much for that. More later. We take a break. We are back and we connect with Mayuresh Joshi, Director of Research at Marksmith India, for some specific stock conversation. Lots of business updates to discuss as well. Stay tuned.
Welcome back. Hope you're having a good morning. As promised, we have Mayuresh Joshi, Director of Research at Marksmith India, who joins us on the show. Hi, Mayuresh. Good morning. First time we chat this year. Wishing you a cracker in 2026, you personally as well as professionally. Mayuresh, I want to ask you about a couple of these updates that have come overnight. And the one on the top of mind, I think, most interesting normally is Trent, because we saw that one-way move. The stock has cooled off substantially from the top. But, Mangalam tells us that still these numbers that they reported are still a little bit softish. What's your view after the kind of correction and there are still growth prospects? Your view on the stock?
Morning, Nigel. Wishing you, Rima, Prashant, the entire team at TV18 a very prosperous, healthy and peaceful 2026. When it comes to the updates for Trent, little bit softer, but I think the trend should start evolving as we head into Q4. Because in my opinion, I think even for a large part of the retail manufacturers, including the likes of a large part of the consumer discretionary universe, and including FMCG players as well, I think there will be some element of inventory rationalization which will still take place in Q3. But as demand trends start coming back slowly and steadily, and as that evolves over the next few quarters in a more structural manner, my own sense is that local and domestic manufacturers and the apparel makers with attractive price points like Trent has, like V2 Retail as an example, like Vishal Mega Mart as an example, I think they should start incrementally adding to better volumes with better margins, and therefore the bottom line growth or DPS ratings as we see it should improve. So again, a little bit softer than expected, but my own sense is that from Q4 you should see some element of a transitional change happening for all these players.
Trent, 2025 was the year of big price correction in the stock, 41% lower last year. And FI has also trimmed their position. The FI holding in Trent in September of 2024 was 26%. And in September of 2025, it came down to 17%, a little below 17%. So FI's trimmed their position quite drastically, 10% plus in Trent in the last 1 year.
Remember, 25 was, as you said, big price damage.
Yeah.
24 was big price gain.
Yeah.
It was, I think it was up. Did it double? It closed 23 at $3,000. Yeah, it doubled basically, right?
It doubled.
It closed 24 at 7,000, and from 7,000 it closed 25 at about 4,300.
Yeah.
So yeah, I mean, as they say, right? What you do in the future depends on what you've already done. So yeah, there is that element, certainly.
Yeah, it's just that the company's now gone from a phase of hyper growth to a normalized healthy growth.
Yeah.
And I guess the valuation is still, resetting to, for trends, maybe slow and steady kind of a top line growth. But again, standalone revenue growth at 17% is still very, very strong. Mayuresh, 3 big banks, private sector banks came out with their quarterly updates. HDFC Bank dipped yesterday, post the announcement. Today, we've got Axis and Kotak Mahindra Bank. I know you like ICICI Bank, at least what you've shared in the past. But between these three, which stands out for you? Would you look to add or, to any of these three top banks?
Morning, Rima. So you're absolutely right. I think ICICI is something that we carry in our local and global portfolios. But within the other top three, I think HDFC Bank is something that can be kept on radar. I think a decent update that they had come out with. I think for the larger private sector banks, deposit accretion is going to be key over the next few months. And therefore, I think with the asset base that they're probably carrying, as deposit accretion probably accrues in a more stronger fashion, and what kind of advances growth then takes place, because the credit deposit ratios will remain relatively stronger for a large part of the banking universe. And so will be the other elementary parameters that you probably look at, asset quality pressures looking stable as we speak. But I think deposit accretion is going to be the key. And I think the banks which are probably able to do that better might present better earnings. I think HDFC Bank might just stand out on that aspect.
Mayuresh, talk about in the financial space, L&T Finance has done so phenomenally well, right? And over the last couple of years, the new, not the new, but not so new CEO has put out clear roadmap in terms of very, very granular details about what they want to do to the portfolio. I remember we had them, I think, in the last 1.5 odd months or so here on the program. Any thoughts? Do you have a view, L&T Finance? Again, a company which posted a business update.
Morning, Prashant. I think a strong business update. And again, for NBFCs as a space, I think Q3 should be the start where a large part of their earnings deterioration should largely be left behind. You have obviously seen the interest rate curve go downwards. And therefore, I think the better rated NBFCs will have the added advantage in terms of better borrowing costs. And that will lead to better and stable NIMs and spreads as we head into the next few quarters. Similarly for banks, I think NBFCs with a stronger capital adequacy will stand to gain. And again, I think the diversified portfolio is something that will aid these NBFCs going forward. And therefore, I think better rated NBFCs, leadership NBFCs should continue doing well. Our top picks have been Shriram Finance, as I've been saying. Bajaj Finance, in our opinion, probably looks strongly placed as well. They might have those tailwinds in terms of the diversified base that they've probably got, the cross-selling opportunities that present itself, the cost optimization that they're probably doing. So these two probably remain on top of the rack, followed by L&T Finance and to a certain extent Chola Finance, which has obviously been in the news. But Shriram and Bajaj Finance remain top of our rack.
Okay, Mayuresh, I wanted to ask you about some of these FMCG names. They've actually been relative underperformers, but yesterday, they were outperformers. Nestle, HUL. HUL has been a rank underperformer, but yesterday was showing some signs of life. Any of these stocks you like?
So Nigel, within the pack, I think Marico is something that we continue holding. Decent update from Marico as well that has come out. And therefore, as I said, Q3 might be a quarter where a large part of that inventory rationalization might take place. But Q4 onwards, as demand starts coming back, and as it trickles down with input costs remaining far more stable, you should see far more stability in terms of the reported EPS numbers. Having said that, I think outside Marico, Nestle had reported a very strong Q2, and they had pointed out that Q3, Q4 might also be relatively better. So I think out of the large caps, Nestle India had a very strong show. And if they continue that show, I think the momentum can very well continue. And one stock that we've kept on our radar is Tata Consumer as well. The India tea business, branded business doing well. Sampann, the portfolio itself is expected to pick up, and therefore the Indian food business expected to remain strong and stable. The international coffee business obviously is facing some headwinds and challenges in terms of rising coffee costs. But I think expectations is that they might do a price hike in Jan, followed by one in March, to probably ensure that the margins are probably protected for their international coffee stroke beverages businesses. So this is one stock that we probably kept on.
Mayuresh, we reported yesterday, just to kind of move away from some of the business updates, etc. My colleague Yash reported yesterday that the government, Department of Financial Services, has sent letters to both the Life Insurance Council and General Insurance Council as a way to reaching out to specific, basically all companies which are part of these councils on the life and general side, asking them for commission details. This, of course, after the RBI raised concerns, IRDA and its annual report has raised concerns. And of course, the DFS himself, the DFS secretary himself told us that, IRDAI is going to be coming out with draft regulations soon. That's the story. Any thoughts around this? Because insurance, again, will be in focus on the back of earnings, but there is this commission bit which perhaps will keep things, capped for now, for specific companies like PB Fintech maybe.
Absolutely, Prashant. And I think that's where the fear of the market is. I think if earnings probably remain capped to a large extent, the kind of valuation re-rating or the P multiples probably getting revised, the probability of that probably gets revised on the downward side. Having said that, I think we've all spoken about opportunities that both the life and non-life segments present itself. Private players making strides in terms of market share gains. However, I think this bit is something that might cap off the kind of incremental gains that would have been expected over the next few years. And obviously, I think the new income tax rules, how does that probably veer savings towards life insurance products, which is essential. But I think what probably happens in terms of growth for new policies, how does that impact the new premiums, and how does that impact the value of new business margins is to be seen. Out of the life insurance pack, I think SBI Life still has a relatively better parameter in terms of the cost dynamics. Their commissions and other expenses are capped to higher single digit compared to the rest of the pack, including HDFC and ICICI Pru, which are probably around that 18 to 22% mark. So that is that advantage that SBI Life probably has.
Right.
Outside that, our own sense is that it might largely be a neutral in terms of earnings sensitivity.
Okay, all right. Mahirish, I know you have to go. We had more questions, but maybe later. Thank you very much for joining us. It's always a pleasure. Well, CSB Bank management is now with us as promised. Third quarter business update came through. Stock was, it ripped higher yesterday. So gold loan segment, of course, has been doing very, very well. Deposits also grew about 21%. Pralay Mondal is MD and CEO at CSB Bank. And Pralay, good morning. Great to have you, as always, here on CNBC TV18. Wishing you a very happy 2026.
Good morning, Prashant, and happy New Year to you, Nigel and Rima, and all your viewers. Wonderful meet again. Thank you.
Thank you very much. Just for our viewers, Pralay, let me just put out the three things we're going to talk about. Will the gold portfolio continue to shine further in coming quarters? Will net interest margins grow further towards that 3.9%? And number three is asset quality reflecting scope for credit cost reduction. So broadly, we want to sort of, cover these three things in this conversation. Pralay, 46% jump in your gold loan book. It's now 51% of your sort of overall book. Of course, underlying gold prices have done so well. International prices up 65%, rates start to 26. So talk to us a little bit about your comfort level here. What is LTV now at? I'm assuming LTV would have fallen, right? As prices continue to rise. And any risks you see here at all? We had, by the way, Muthoot with us, I think, last week, and I asked them, in a way, the same question, and I asked them about risks as well, whether it's a segment which is kind of I don't want to use the word overheated, but heated certainly. So are there any risks at all from regulatory side? Go on.
Yeah, Prashant, I think what you're saying, we are all cognizant of that fact, and we are all taking our own kind of a risk mitigation to that extent. Depends on the risk appetite of respective institutions and banks. For us, we are not using pricing or the LTV as a kind of a component of growth, because our LTV, as you rightly said, has come down almost below 60% now. So we have a comfortable 15% margin on that LTV. Plus, for agri gold loans, it is much higher. So to that extent, we are sitting on a very, very high cushion and safety, and we are not taking growth at just because the prices are rising. So that's one. Secondly, the tonnage is also increasing. It's not that it's only growing by the growth. While LTV is falling on one side, the tonnage is increasing. So to that extent, and also these are short-term loans. So to that extent, we do our kind of a sensitive analysis of 10%, 15%, 5%, 3 kind of pricing. If it falls, what happens, what tenor, etc. and we are taking our tenors down. So to that extent, all risk mitigations are in place. So I don't see any risk at all in our particular portfolio.
Could you take us through, good morning, through the stress test then? If gold prices fall by 10%, they fall by 15%, they fall by 20%, the collateral buffer also vanishes. As you said, you've been constantly doing these risk analysis. Can you tell us what it throws up for your portfolio?
So, Rima, I would know that now, as per the new regulation, the interest also is inbuilt into the LTV. And these are relatively shorter tenor loans, anything within 6 months to 1 year. And to that extent, if you take even a 5% kind of a fall or a 10% kind of a fall, we are within the LTV, well within the LTV. And let's not forget that LTV 75%, after that, there is another 25% margin. So that's the average. I think where the challenge will be for respective players is not looking at the average, but what is the marginal portfolio which is above, let's say, 75%, especially on the agri portfolio. And that's what needs to be monitored carefully. But for us, it's looking very, very safe right now.
Okay, so even a 5 or 10% fall in gold prices, you will still be within, at least for the gold portfolio, LTV of 75%. So that makes you comfortable. Also, one question, this 46% gold loans, what percentage of that came in from top-up loans? Because your existing borrowers can also borrow more against the collateral that they've given to you versus the new fresh loans on the gold side.
So as you know that this renewal or top-up is something new as per regulation, but generally the customer will close the loan and open the loan. So to that extent, within the system, it will show as a new loan, irrespective. And that's why we'll see that the disbursements per quarter, even if it's existing customer, is quite high. And when they take a fresh loan, the top-up will be based on the LTV comfort which we have, which I've already shared in terms of what kind of LTV comfort we have. So to that extent, we don't measure that top-up because they come it as a new gold loan. But next year onwards, I think rollovers and top-ups we will start, and then we don't need to close and open loans again. So we'll figure that out next year.
All right. Hi, Mr. Mondal. Good morning and good to see you. And as always, I recall a conversation we had 18 to 24 months ago when I was trying to understand the business and explained it here on CNBC-TV18. And things have moved very, very well. Your market capitalization is more than doubled since then. That said, let's understand a couple of aspects. As you mentioned, gold loan, there has been a tonnage growth as well. So if you could quantify that for us, what has been the tonnage growth?
Tonnage growth has been relatively low. It is somewhere low single digits, I'll say. But definitely what I mean is that there is also a tonnage growth and new customers are coming in. So to that extent, it's low single digits. Yes.
Got it. All right. Now, gold is a large proportion of your book. And in the past, you have mentioned in the years to come, I think around 2030 odd, you were talking about the proportion of gold coming down as a percentage of the mix. How do things stand? And in the near term, going by the way gold prices are moving and the kind of interest you're seeing, maybe the gold percentage actually goes up, maybe towards 60%, and then it comes down. So tell us, as a proportion of business, how do you see it move?
So, Nigel, gold is a tactical play for us, but the real strategic play is building the wholesale, the SME, the retail, and all of these other franchise. And the big update about the bank is the entire tech transformation, which we have done, which I've been talking for a while. And now with 52 surround systems and core system migration to FC, Oracle, and with OGL, OFSA, many other things which are doing around it. I think we are now ready as a full-scale bank to launch the new products. For example, this quarter, you'd see when we give segment-wise analysis, when we show the results, is our wholesalers run very well, for example. So various franchises are starting to pick up. Having said that, we take it when there is an opportunity, and that's tactical from a gold loan perspective. But our future, we are not depending on gold loan. The second part is that also part of this growth you're seeing in gold loan because of a regulatory change which happened this year, which is repledger business. After 1st of April, we cannot book it. So what we did is we strategically are moving out very fast of that portfolio, which comes under retail. And hence, we are seeing some growth coming down in retail, but that's effectively gold loan, which is getting replaced by normal retail gold loan. So to that extent, I think our long-term commitment remains. We have to build our liability franchise. We have to build our branch banking. We have to build our wholesale SME and retail. But gold is a tactical play. Yes.
All right. Talking about it being a tactical play, I'm noticing that a lot of competition as well is eyeing this portfolio. So tell us about the competitive intensity. How do you see that panning out? And also, since there is so many new entrants coming in, there's so much of focus on the gold loan portfolio. Do you think that yields could come under some kind of pressure? Yes, you're a far cry away from the core gold financiers, but yet do you think it could put pressure on yields?
I don't think so, because we are anyway much lower than where some of the other NBFCs and banks are in terms of yields. So to that extent, we are in a safe zone from that perspective. But Nigel, I'll tell you what interesting phenomena which is happening in this gold loan business is that ticket sizes are going up, and these are coming from SMEs. And a lot of these business loans are getting replaced by secured gold loans. And I think now the realization of the value of gold and from the SME working capital perspective is coming up. So my original thesis that we'll bring down gold below 20%, we are setting up a separate kind of a play on this new segment which is picking up, and that is something which will focus very, very strongly, which is working capital loans where gold is a collateral. So I see, and gold, how much locked-in value is there in the country today, including the SMEs and everybody. So to that extent, I think there is a large play out there.
Yeah, okay. Just to complete the point on gold, Pralay, you said gold tonnage growth is low single digits. What about members in terms of the member base?
The numbers of customers we are not growing that much because we are increasing the ticket size, not based on pricing, but based on the segments which are covering more and more, because the smaller ticket size generally don't come to us. They can go to the higher yielding kind of NBFCs and institutions.
But Pralay, you're saying that tonnage growth is very low. The number of customer growth is very low, but loan growth value is very high. So is that, how should one read it?
So tonnage growth is around, what happens is tonnage growth, it's not that when gold prices comes down or remains stable, then tonnage growth will also pick up, because finally tonnage is based on what working capital or what requirement you have. So people will give more gold to you to get higher kind of a loan. So to that extent, it's not directly correlational to the tonnage to the value. And my thesis is that once the gold prices starts coming down or stabilizes, the tonnage growth will automatically pick up. Customer addition is our own play. It's not that we are not adding customers. We are adding different segments of customers where the ticket sizes are larger. And as I said, that our LTV is pretty low, and new LTV is actually around 60%. So to that extent, I think we are not taking that play so much on the pricing. We are taking the risk parameters pretty well.
What is the average ticket size for you?
Average ticket size will be, I think, between 3 to 4 lakhs.
3 to 4 lakhs. Got that. We quiz you a fair bit about gold and gold loans, but that's the segment which is doing phenomenally well for you. We wish you all the best of luck. Thank you very much for joining us here this morning and running us through what you see going forward. So that is CSB Bank has done extremely well. We'll take a break. We're back. Hormuz with us with the big movers from yesterday. Stocks with price action and volume action as well. We'll also connect with Sudarshan Sukhani and Mitesh Thakkar on technical trading ideas. Stay tuned. Coming up.
Welcome back. Let's prep you up for today's trading session with the big movers yesterday, which saw very heavy volumes, price action, and let's see what the momentum can continue in these stocks. Hormuz.
Rima, and CSB Bank, you just heard from the management, but the price action yesterday was something to tell. 16% higher on the stock yesterday. It was the biggest single-day gain since its listing back in 2019. The Monday's volumes, they were the highest since its listing day, which was back in December of that year. Close to 1.5 crore shares were traded, a 20-day average of around 4 lakh shares. 22 lakh shares marked for delivery compared to a 20-day average of just around 2 lakh shares. And the stock in the last 12 months has gone up by almost almost 75%, including yesterday's move. Tourism finance was a stock in focus yesterday, remains in focus today as well. Ekta Halwasia has remained a buyer for the second day in a row. Monday's volumes were 2.5 times of that of Friday when the stock ended in a lower circuit. Yesterday, the stock ended in an upper circuit, and almost 11 crore shares traded, 20-day average of around just 80 lakh shares, and out of those 11 crore, 3 crore were marked for delivery, the 20-day average of around 36 lakh shares, and over the last 12 months, the stock has almost doubled in value. And lastly, Sai Silks Kalamandir, the stock was down 12%, is the top loser on the small cap index yesterday in reaction to its business update, and the stock, the biggest single day fall since September of 23. Monday's volumes were the highest in the last 3 months. Almost 62 lakh shares were traded yesterday on Sai Silk, 20-day average of just 6 lakh shares, and out of those 62 lakh shares, 24.5 lakh shares were marked for delivery. Their 20-day average is just around 2.5 lakh shares, and as a result of yesterday's fall, the stock is down almost 40% from its IPO price, which is around 220 rupees.
Thank you very much for that. By the way, Asia is continuing and extending the global rally. Strong gains yet again. Hang Seng up 1.5%. Nikkei, that's the Japanese market, which closed up with a gain of 2.5%, has added on another half to 1%. And Taiwanese markets too, gaining close to about 1%. GIFT Nifty, there you have it, up 50 points. Get into break. On the other side, we'll get you more on the pre-opening rates. We'll connect once again with Sudarshan Sukhani and Mitesh Thakkar for some technical trades.
Welcome back. Sudarshan Sukhani is with us, and so is Mitesh Thakkar with what they'd want you to do as far as trades this morning go. Gentlemen, good morning. While the Nifty sulked yesterday, broader mid and small cap price volume action did not look discouraging in that sense. Actually, it was a pretty buoyant screen. What would you do? Sudarshan, you go first. What's the sense? Indices first.
Yeah, good morning. See, we had two big, large range days of big rallies last week. So the markets will have a pause. They will do some corrections of some kind. Sometimes they become choppy intraday. And that we have to accept. It's something very normal. So the trend continues to be up. Any index that makes lifetime new highs should be bought into. Now, 2026 could be different because normally we have that Santa Claus rally, which we talked about. Apparently, we could be having it post Santa Claus. I would be a buyer in the Nifty. The Nifty has been making higher lows. It's making a lifetime high. All the environment is ready for a decent up move. Every dip is a buying opportunity.
What about Mitesh? Come in. What's the call on the Nifty for today, for the near term? Any trades?
Yeah. So, yesterday we had some kind of a decline, but looking at the structure, to me, this looks like a pullback. For example, Nifty, had multiple tops around the levels of 26 to 20. And I mentioned upper end resistance, which is the upside sloping line at about 26, 400, 425 zone. So we kind of came back from 26,370, but did not break below this 26, 200, 220 zone. So unless until we break that, I think this will be a buying opportunity. We will have a stronger breakout in case the Nifty, starts to go up and close above 26,430. Then I would even look at 26,950, 27,000 as the target area. But for the time being, around 26,220, longs can be taken with a 50-odd point kind of a stock.
What about stocks, Mitesh?
Yeah, I have three buys and a sell. On the buying side is Bosch. It had a big breakout kind of a candlestick move, which happened on Friday, and then yesterday was more of a subdued movement, sideways activity, but it should resume its uptrend again. So buy here with a stop at about 38,750 for targets of 40,000. Chola Finance is a buy with a stop at 1754 for targets of 1815. Also a buy on Cipla. Keep a stop at 1507 and look for a short target of 1545. And one sell call. I think Cummins has had a breakdown kind of a chart structure. So sell on a mild pullback, say around 10-20 points higher, 4320, 4330 being the selling range. Keep a stop at 4375 and a target of 4225 is what I would.
Okay, all right. Got that, gentlemen. Sudarshan, what about you?
Well, it's an all buy list. Siemens is a buy with a stop under 3030. Balkrishna Industries is a buying opportunity, stop under 2350. MFSL, Max Financial, is a buy with a stop under 1675. And finally, BSE is a buying opportunity with a stop under 2625. My algos may be having a position in BSE, but generally, I'm on the long side.
East in pre-open, HDFC Bank is suggesting a further downtake, so that's down 1.5%. And that's the reason why the Nifty and the Sensex are also absolutely flat. It's not showing the optimism that the GIFT Nifty showed. And trend could weigh on, on the markets today. Trend in pre-open is down nearly 3%. Gentlemen, technically, trend. Sudarshan, go first.
But trend is a complete avoid. I would not go for it. It's not done much. It's been a dismal underperformer in different periods. So it's a complete avoid for me.
Mitesh, is there a trade either on the downside or is there an opportunity to buy into the correction when it comes to trend?
Yeah, I think the stock has corrected big time from 6,200 to about 4,000 and then it's trying to bounce back. Now today will be a pullback to the short-term averages. In case I get an entry closer to about 4,300, I think that's when a long entry is what I would recommend. And on the upside, it will be very difficult for the stock to get past 4570, 4600 zones, but that could be the target area. So try to buy it around 4300, take a 70, 80 point kind of a stop loss, and 4570, 4600 is the target area.
Okay, all right. 10 minutes to go for the market open. Pre-open is kicked off, and we'll have some of those rates come up for you in just a bit from now. 60 points lower, 26,190 on the Nifty. Well, what are the brokerage calls of the day and what you should pay attention to? Sudarshan is here with exactly that. So over to you.
So first one is Jefferies has initiated coverage on MV Photovoltaic with a buy call and target. Here is rupees 320 per share. It says solar installations are set to grow at a 24% CAGR over FY25-28, and companies' early entry into TopCon superior DCR-driven profitability and healthy balance sheet give competitive advantage to the company, and also industry profitability should normalize by FY28. It projects 56% EBITDA CAGR over FY25-28 and price company at 9 times forward EV to EBITDA. Next one is on Maruti. HSBC has a buy call and target has increased to 18,500 per share. It says market share for the company has normalized and it's back to 40%. And with all these stars are aligned, Q3 and Q4 margins will be very critical. If company reports margin below 10%, that would be disappointing for the market. But as far as the demand is concerned, it remains very strong.
Okay, all right. Thanks a lot for that, Sir. Hopping across to Ekta. Citi has written a note on Divi's laboratory. Ekta joins in to tell us about that. Ekta?
Well, yes, Citi has a buy with a target price of 9140. What they've said is that 2026 can be an inflection year for Divi's. The company has a strong pipeline of catalysts over the next 12 months, notably GLP-1 as well as contrast media products. Various custom synthesis products are also maturing, according to them, and may be commercialized in the near term. The generic segment too is expected to witness a recovery in 2026. The quarterly numbers may experience volatility and present forecasting challenges, according to them. Medium to long term, the story remains intact. They believe Divi's revenue EBITDA can expand by 3 times to 4 times over FY25 to 30. FY27, FY28 EPS is estimated to be 10 to 8% ahead of consensus, respectively.
Okay, all right. Top pick in the pharma space for 2026 from Citi. Ekta, thanks very much for that. Petronet LNG is the next one in focus. I'm not sure if it's great news here. Sonal is here with what's happened. Sonal, over to you.
Good morning. Yes, it is not so great news, but it is just a draft. So to put things into perspective, PNGRB, which is the regulator, came out with a paper. They've analyzed various costs for all the oil and gas players. It would be something like the upstream segment, transmission segment like GAIL, marketing, regasification, the taxation aspects as well, to figure out whether they need to see more compliance in different players or not. They have made some recommendations now, basis the cost analysis. It would be around APM allocation for all the city gas distribution companies, rationalization of taxes that are seen across the value chain, and also regulation of regasification. Now remember, gas is imported in liquefied form. It is regasified and then transported in the country, which is done by Petronet LNG, the regasification bit, which is now not regulated by the PNGRB. It is basis the market forces, but they are now talking about regulating it. So Citi says it is once again underscoring the PNGRB's is belief that even regasification terminals should come into regulation. And that is something which the investors might not like, because it would create a lot of compliance issues. Plus, there could be some caps as well on tariffs across the board. They maintain the view that regulatory and competitive dynamics could shift the bargaining power in the favor of competitors of Petronet LNG's off-takers, and not so much beneficial for Petronet LNG itself. Potential renegotiation risks are there to Dahej regas tariffs for the renewed Qatar contract, because there could be a possibility of tariff caps, and that is something which will not be good for Petronet LNG. Just a paper yet. If it does get finalized, Petronet LNG will be in focus.
Thank you very much for that. Back to trend could once again be the stock of the day, down 3% in pre-open. Mangalam, you were telling us 17% growth doesn't quite cut it.
Well, it doesn't, and in fact, the stock is now settling 5% lower in pre-open. The volume's also decent, but we'll have to see where it goes when it actually opens, for the simple reason that the stock, one, has corrected about 41% in 2025, but at the same time, from its lows of around 3,900, the stock has also seen a rally of about 10%. So just to once again reiterate those numbers, it's a 17% growth that the company has reported on a standalone basis. What's good about this quarter's update is that you have a higher number of Westside and Zudio stores added than expected. So store addition is a positive. But if you took all the stores that were added in the last 1 year, it would appear that with the revenue growth of 17%, there is a negative same-store sales growth and reduction in sales per square foot also. The company at the start of the financial year had said that maybe 20 to 25% is the sort of revenue CAGR that the street should adjust itself to. That itself was lower than the over 35-40% CAGR that the company was reporting in the previous 3-4 years. So the street was adjusting to that, and just as that happened, the last 3 quarters, the revenue, including the third one, have not crossed 20%. It's between 19, 17 and 17% itself. So where it grows from here is something that the street will definitely eye. Another aside on trend, at peak, the stock was trading at around 140 times earnings, a little more than that as well. And the street was comfortable with that because the growth, the EPS CAGR, was much higher, and as a result of which the price earnings growth, the PEG ratio, was a lot more comfortable. But now as we speak, even if we're looking at EPS CAGR of about 25%, the stock trading at 70 times, the PEG ratio is a lot lower than what it was when the stock was at 140 PE, which is what explains the disappointment on Trent stock.
All right, Mangalam, thanks very much. But Dabur is the other one, right? This one also maybe needs a bit of a Chyawanprash boost.
Chyawanprash boost, or maybe some bit of Dabur Active juice as well. The reason why I say that is because the weakest part of the portfolio this time around has been beverages. The other parts of the portfolio have done well, which is why the company has reported mid-single digit sort of consolidated revenue growth. The EBITDA and the net profit have continued to grow ahead of revenue, which means there is margin expansion. So these numbers aren't particularly bad. My sense is that Dabur will see a recovery because the third quarter also saw an impact of trade, taking out inventory, high-price inventory in the month of October. November and December is where consumer sentiment saw improvement. Home and personal care business actually reported double-digit growth. At the same time, we saw decent growth come by in their healthcare business as well, maybe because of the Chyawanprash. But the beverages business, the juices portfolio, took a hit because of adverse weather, which is why the stock is settling mildly lower in pre-open. But let's see where it goes from here.
All right. Thanks very much for that. That's Dabur, which is in focus. Let's look at a few other names, right? Maybe why not just look at the top 10 list of stocks that we put out in the morning for a quick pitch. So maybe IndusInd Bank should come up. Yeah, there you go. Kotak Bank, Axis is up about 1.5%. L&T Finance is up about 1.25% or so. And there is IndusInd, which is down about a quarter. Tata Motors passenger vehicle business also came through, and there is some amount of pressure there. What else? Adani Ports is down about 0.25%. IEX, where there is a case comes up in the appellate tribunal. Dabur, of course, Mangalam just highlighted as part of the list that we put out in the morning. So that's a bunch of stuff coming through. I suspect, once again, with the overnight rally we have in commodity prices, especially copper, and we should look at, maybe Hindustan Copper should come up on your screen.
Hindustan Zinc.
Hindustan Zinc is the other one. Silver, right? Of course, the entire commodities complex, Vedanta, even, Hindalco, Nalco, etc. have done phenomenally well. already, it's about 6 days into 26, and they've already, I think, notching up gains. So keep an eye out in the metals pack once again as we start.
2025 was the first year since 1980, if just going by what articles say, where gold, silver and copper all simultaneously hit record highs. But usually, because copper and precious metals give you contra signals on the macro front. Copper does well when growth is higher, you're positive about the economy, and generally precious metals did well when you were negative and you feared recession and it was seen as a safe haven buying. But last year was the only time since 1980 when all three hit record highs. By the way, just one word on IT. Yesterday, it was a cautious note by CLSA where they said trim positions in IT after a 14% rally seen in the Nifty IT index in the October to December period. Today, Jefferies has come out with a note, and they're saying the risk of earnings downgrade still remains. So their argument is that in FY27, growth will pick up, but it picks up only to 4.7% on an aggregate basis at the headline level. But this is still lower than consensus expectations of 5.5% to 6%, which means there is a risk of earnings downgrades, which could then put pressure on the PE multiples. So that is just the limited point, as we kickstart the earnings season from next week for IT.
Yeah, no, absolutely.
5 seconds to go.
5 seconds to go. First rate starting to come up, and we should be on our way. What do we have? First rates in 70 points, 85 points lower on the Nifty. The sensex is down about 300 points, and Nifty Bank down about 0.18. So just starting slow and sideways. The small cap index is up about 1/3%, and the mid cap index should come up on your screen is down about 0.16 as well. So no great shakes. It's a quiet, grinding kind of start, at least on the indices. Let's see what's the picture like as far as the Nifty 50 heat map is concerned, how many up and down. And then we look at individual single stocks and how they are all starting. What do we have? HDFC Life on one end, Tech Mahindra, Kotak Bank, Hindalco, Bajaj Auto. Very few names in the red. So bulk of the Nifty stocks are higher, and the Nifty itself is down 25 points. Trent and Reliance, I think the fact that RIL is down as a heavyweight, perhaps adding to a bit of pressure at this point. But it's not much. I mean, it's just about 20 points, less than 20 points now. So coming up very, very fast, very, very quickly. But this is the first minute and a half we're talking about as far as market opening goes. Rima.
Well, let's just delve a little bit more in the Trent's price rate. Trent is now down 8% at opening, taking its one-year loss to 42%. The street does not like the moderation in growth. In Q3, top line went up 17%. In 9 months, FY26, the top line growth is about 18%, lower than the 20-25% that the company was signaling in terms of a long-term, medium-term kind of an earnings growth, and much lower than the 39% top line growth that they clocked in the period of FY20 to FY25 when the company was a growth beast. So the street is punishing Trent, still down 7.5%. The other problem is Reliance Industries. Reliance Industries is down 2.5%, and HDFC Bank has lost close to about, 4% now, 4% plus in the past 2 days. Yesterday also it was down more than 2%, and it's seeing follow-through selling pressure. Tata Motors passenger vehicles December update in terms of sales didn't look good, and that stock is under pressure. Adani Ports has had a flat opening. They too came out with their update for the month of December. Well, the key takeaway is that container, which is the growth engine, is doing very well. That's up 8%. But the overall cargo growth is at 9% because bulk rail is seeing a bit of a sluggish growth. On the way up, it's the two banking names, particularly Axis Bank and ICICI Bank. Let's get the early rates up. Now it's settling. Kotak Mahindra Bank is up over 1%. Axis Bank has a gain of about 0.6%, but they're being supportive. Commodities are having a good start to the trading session. Hindalco is one of the top gainers today. It's hit a fresh 52-week high, 950 almost on Hindalco. Tata Steel opens up in the green. We should pull up SAIL as well, where the quarterly update looked pretty healthy. And HDFC Life, Apollo Hospital count as some of the other big movers. And ICICI Bank too. In fact, the entire private sector complex minus HDFC Bank is having a good start.
Well, that's right. Exactly a month ago, we here at CNBC-TV18 had put out this piece on aluminium stocks. And from there, some of the stocks that Rima mentioned, Vedanta, Hindalco as well as Nalco, they're up between 18 to around 24%. So that's the kind of move that we've seen on aluminium. And the reason we covered aluminium was because there are more number of stocks with exposure to aluminium. For copper, the sole player on copper is Hindustan Copper, and that one, in fact, is up close to around 2.5%. A few more stocks on the broader markets that are calling for attention. KSH International stock is moving up on massive volumes. They came out with their Q2 numbers yesterday, actually. That's the Q2 FY26. Revenues are up by close to around 50%. EBITDA is up, I think, by close to around 74%. And the EBITDA per ton has gone up by 40%. So KSH, that's one stock that's buzzing in trade. Another one is a stock that Sudarshan mentioned. Jefferies, they have initiated buy on MV Photovoltaic with a target price of 320 rupees. The street is taking note of that. That stock is well in focus today, reacting to the Jefferies note, MV Photovoltaic. So let's get that one up for you on the screen. Kandar Oil, well, that's a stock that was up, I think, 16-17% yesterday. It's building on the gains today as well. Stock is up another 6% as we speak. So big up move is what we're seeing out there. Cupid, well, that stock has bounced back now after a couple of days of drubbing. It's up close to 7%, one of the top volume movers in today's trading session. I'll tell you what, on the Nifty, if we have to see a recovery, two of the large weighted stocks will have to give their underperformance. We have Reliance Industries that's down close to around 3%. That's weighing on the index. And HDFC Bank for the second day running. So the Nifty, if it has to recover, then we'll have to see both these two cut off their losses, because put them together, that's more than 20% of the index that's down 2.5% to around 3%.
Even Dabur is down, 2.5%. It's reported they're expecting a mid-single-digit kind of a top-line growth in Q3. Rural demand is outperforming. Street doesn't like it because you're still not seeing a full-fledged, full-blown FMCG recovery, despite all those GST revisions. So I thought they were okay, but the street is hitting Dabur right now.
Well, I think, across it's basically slightly sideways, right? 60 points down, and we're now starting to settle in. So the cheer we are seeing around global markets in Asia, etc., and most global markets have had a pretty strong start to 26, which is a repeat of what we've had in 25. And here in India, we're kind of sort of repeating what we've done in 2025, which is not very much. So sideways, 26,200 with a 50-point dot cut. Market breadth is 1,100 up and about 1,300 lower. That's the NSE tally at this stage. I think the outsized pressure is coming from Reliance, which is down 3% this morning. So RIL header is, I think, largely the reason why we are seeing this pressure, which is come through. It's a stock which has basically started the year with high hopes. Almost, I think, did we get to all-time high in Reliance? So the high was about 1609. We made a new all-time high. We made a new all-time high yesterday. 1611, 1612 was a new all-time high in Reliance, and now we're turning down a little bit. So about 3.33% down on this one. Trent, of course, we've highlighted. Vari is another one. Swiggy is down 3%. CSB, but CSB, etc., had such a vertical rally, right? From 400 rupees to about almost 600 in 10 trading sessions. So that is understandable, a bit of a pullback. Premier Engines and more. Godfrey Phillips is down about 1.5%. Saman Capital is down 1.5%. KPI Green, Petronet Sonal was highlighting 1.5% lower. Devyani, where there's been news slow, 1.75% down as well. More down than up, certainly.
Even Merck Electronics, Nimesh was highlighting it in dealing room chatter, where there is a possibility of a management rejig. Yesterday, stock was locked in an upper circuit of about 10%, and today as well, lots of buying, stock up nearly 5-6%. Yeah. Merck Electronics, there you have it.
Yeah. Okay. Well, let's get in Venugopal Gare, who's with us. He's Managing Director, India Head of Research at Bernstein. Venu, good morning. Good to have you with us here. Wishing you, your team, your family a happy 2026.
Same to you, Prashant, and to the entire CNBC team.
You've the headline first, right? You've cut your view or rating, whatever you want to call it, in India by a notch. You're neutral, Venu. Yeah, it's a bit of a non-consensus view because for what it's worth, across the board, if you look at sell side, we've had upgrades, not downgrades, after the lackluster performance in 25, Venu. So your call in that sense stands out. So run us through, although if I look at the Nifty targets, etc., it's not as if others who upgraded the view are expecting, a big year in 26. They're all expecting 10, 12% kind of growth. I think your target gives us about an 8% upside. So that's the short preamble. I'd like you to explain, what led you to this downgrade?
Yeah, so it wasn't planned as a non-consensus view. Probably it just ended up happening like that. But I'll give you a very interesting context. 2024, I'll just bring you back 2 years back when everybody was positive on the market. I had started the year with a book profit call. And interestingly, I had an 8% Nifty return target of 23,500 that calendar year. And we all know what happened that year. Things started to peak off and materially correct in the second half of that calendar year, both from an earnings standpoint and a valuation standpoint. Interestingly, as we head into the previous year, 2025, my call was that macro has bottomed out in 2024 end and macro is going to start to recover. Rates will start to get cut. We should be selective buy. And selective buy was largely with the view that SMIDs were still very costly. Heading into this year, the argument of moving to a neutral with a 8% return, which is similar to what it was 2 years back, and not a book profit call or a sell call, is simply because I guess things are slightly different at this juncture, where macro, while has peaked at around 8% GDP growth rate, is going to only fade out to a 6.5% growth over the next few quarters. So we're not really seeing any major macro collapse. Number two is earnings growth has been fairly meager in this financial year. It is expected to return, but I think a lot of that recovery in earnings growth is already priced in. More importantly, I do really believe that we are exhausting in terms of policy variables to drive growth. A lot of shift of the burden of economic growth has to shift to private sector, which may not yet be ready to handle that. Rates, there'll be some cuts, but not substantial enough. Government balance sheet is not like in a great situation for us to essentially drive growth through that. Fiscal deficit remains a concern. Putting all of this into picture, you essentially see a situation where there is positives around a bit in almost everything, but not substantial enough for us to believe that you should be able to make substantial outsized returns. And lastly, the main point is this, that even this 28,100 Nifty target 8% return was after factoring in 13.5% earnings CAGR over 2 years and using a 19x multiple on 2-year forward earnings. So by the way, that's not like, conservative at all. And yet you get a very modest return. So that was a challenge we were finding at this juncture to get returns.
So Street was banking on earnings growth to provide the fillip to the Indian markets to play catch up versus the rest. But clearly 13.5% earnings CAGR over the next 2 years is not going to help us give very strong return. Wanted to get your view on real estate because you've upgraded real estate after the underperformance seen in 2025. Now, the question is from 2020, which were the post-COVID lows and bombed out, real estate gave exceptional returns from 2020 to 2024. And we've had only a 1-year period of correction last year where the Nifty Realty Index and stocks were down 15-20%. I mean, has it corrected enough? What is the call behind real estate?
Yeah, so I'll bring this to a very interesting situation. When you expect broadly high single digit or meager returns in India, it becomes very interesting in terms of how to essentially pick stocks. One of the key things that we saw last year, there was a separate report we wrote in terms of decoding 2025 performance, was the aspect of catch-up trades. So catch-up trades did meaningfully well, which is essentially stocks which didn't do well in 2024 but started to recover in 2025. And honestly, there wasn't an earnings growth anchor or an earnings revision anchor. These are just catch-up trades. Now, interestingly, when we saw last year, there were two sectors which were absolutely the worst performers, which was IT services and the second being real estate. So what we felt is this, that real estate broadly, if we were to just contextualize it, is usually when cycle starts, it lasts for 6-7 years. We saw a period of positive activity, and that's because it came after several years of a downturn. And you have a period of digestion. But when you look at earnings growth over the next 1-2 years, they are very different, or rather in a positive sense, still positive and a decent growth compared to what you would have probably seen during the phase of downturn. And you've essentially seen a major correction in terms of stock prices. There's the worst performers last year. Plus, the fact that these are also considered as interest rate sensitive sort of sectors. So as the rates continue to moderate, we expect another 50 basis point rate cut this year as well. we think that probably the sector would see some degree of a lift. Remember one thing, that overarching return expectations are not very high for us across the board. So even in a positive return sector, we're not expecting a 30 or a 40% return. It will be better than the 8% Nifty returns.
Okay. All right. Hi, Venu. Good morning and good to see you, Ben. So you're guiding for returns on the Nifty for the next couple of years at around 7.5 to around 8% or thereabouts, and that's how we get to the target of around 28,000. Got that. The other, debatable issue is what's going to happen next and how soon are we going to get a deal with the United States? How big a positive catalyst will that be? And will that alter your view from this neutral stance?
Yeah, so we have factored India-US trade treaty to get signed this year, and that too within the next few months, based on whatever sound bites we've got. Fundamentally, the challenge that I sort of see at this is that it is a narrative or a positive narrative only for a few days than anything else, not more than that. And simply because what we've learned over the last 12 months is very simple, that unless you are, as a country, associated with a particular camp, which is US, I don't think this trade treaty can be believed to be sustainable. It can continue to change through the year. So that's a fundamental issue I have, that that this is going to be just a point trade treaty than anything else. Also remember from a relative perspective that the broader deal with China has continued all the way till November of this calendar year. So it's not that from a relative perspective, we're going to be primarily viewed as a country where FDI should improve, or there'll be massive swath of manufacturing because India identified as the next China plus one. I don't think all of that is going to happen. So this treaty is essentially going to lead to two things. One, a small up move in the market, currency to appreciate a bit, which is rupee, just a bit, when it happens. That's basically it. And the way I'm hedging primarily this particular event is through the ID services overweight trade.
Yeah, that's an interesting viewpoint, right? I mean, so we know what you're saying is you've got to be unambiguously, clearly in the US camp otherwise it's more transactional and it'll go up and down through the course of the year. Even if this, some sort of an agreement takes place in the next couple of months.
Yeah, so I don't have to look. I would love to have this as a sustainable trade treaty, but I don't get the comfort today that 2 months down the line something changes. So that policy volatility has been a feature of the last 12 odd months.
Yeah. No, absolutely. Just a quick word, Venu. Lots of global thinkers are of the view that 25 was the year of, AI infra kind of names, right? I mean, the actual, the chip makers and the data center guys, I mean, physically and otherwise. And now it'll start to turn into, maybe it'll not happen this year, but next year, maybe it'll start this year. It's going to be AI adopters, cost optimization, etc. People are already starting to attribute, different percentages to, growth per se because of this. Cost ration. It's basically at the expense of labor costs. You think that will work out here in India? Have you thought about it? And which segments will benefit the most?
Prashant, the interesting thing is that we are way far behind at this juncture with respect to AI implementation across the board. If at all you're seeing AI implementations in a meaningful perspective, probably happening only in the technology world, which is tech companies adopting it first. Real world implementations are extremely meager. So what it means to me is that this is not a 12-month story or a 24-month story also in terms of being able to generate or eke out enough efficiencies for you to see margins improving or for you to see enough positives that can be deployed by companies to get volume growth. Not at all a story for the next 24 months. I think for India as well as globally, it's going to be a very slow adoption. A lot of adoption probably in 3 to 4 years will become meaningful. A part of that is also because technology itself and AI solutions itself haven't stabilized. So you need to see a situation where corporates are fully convinced that this is what we need to implement.
You don't think financials, for example, financials is the area I mean, at the end of the day, you need large data sets, right? And who is larger data sets than banks and financials generally? I remember having this conversation with the L&T Finance Management, and they spoke about AI quite a bit and how they've implemented it. You know, that's a pack kind of sort of which comes up first. They've already adopted in many ways, but maybe it'll get done more.
I mean, we call it AI now. It used to be machine learning earlier. So this is just a change of a name than anything else.
You know, one counter argument for a bullish view on IT is that increasingly companies are still spending a lot on hardware. Memory prices, for instance, now have gone through the roof. They've practically doubled. So basically, they're just crunching what would have otherwise maybe come to services, and that hardware spend by companies will continue. So again, just prolonging when discretionary spending for Indian IT services will make a comeback. But you've also downgraded, Venu, to consumer. You've downgraded consumer staples. Now, you know, one part of the camp believed that with the interest rate cuts, the GST rationalization, the tax cut, all this will flow through and benefit the consumer staples. Volume growth will slowly pick up. Rural was anyway doing okay-ish, but even urban will now show some signs of life. So explain to us the rationale behind the cut in the downgrade in consumer staples.
Yeah, so it's a very interesting theory I had. So I was a bit non-consensus when I upgraded consumer staples sometime in April or May of last calendar year, just ahead of the monsoon season. And broadly, it's about volume growth. It had nothing to do with GST because we didn't really know at that point of time that GST would get cut, but the idea was policy will be pro-consumer. Now, fundamentally, if I were to just think about it, the sector has done nothing much, through the year. Volume growths I guess, will inch up a bit, but not material enough for me to get excited. That's number one. So there will be an inch up in volume growth as you see the quarter or two pan by. But fundamentally, the challenge is that this year, when I look at the fundraising happening in, for example, the quick commerce sector, so Swiggy has raised money, and I think the third largest player is also filed a prospectus for raising money. So a lot of money flow will happen on quick commerce investments, which is not essentially that positive for incumbent consumer brands because it does create a pathway for, smaller brands to also be visible in terms of presence. So this competitive angle as well sort of, questions and worries me at this juncture. The other part is I don't know how rural and monsoons will shape up this year. Initial sound bites have been very mixed. So that's another concern today. So it's very hard to take a proactive, positive view at the beginning of the year, especially when valuations are not cheap at all.
All right. Venu, one quick word. The RBI has turned pro-growth, right, for the last many policy meets that we've had, the commentary as well as, the cuts. How many cuts are you all penciling in for this year?
So for me, roughly 50 to 75 basis points depends on, quantum of cuts, but whether it is 25 each. So that's the number that I have in mind. I guess it's going to be difficult to do anything meaningfully beyond this. Part of that is also to do with currency and how well you want to manage your currency.
All right. So 8% CAGR returns on the Nifty. The contra bets will be tech as well as real estate. And in the consumption pack, you prefer discretionary over staples.
So leave us with a slightly upbeat something here. This is like
I call in a very simple way that 8% return is a great return, number one. Number two is this is not...
That's not helping. That's not helping. 8%. Go on. Sorry, I'm joking. Go on. Finish the point.
So I have a lot of buy sectors still, right? Financials is a positive sector. Telecom is an overweight sector. Consumer tech is an overweight sector. And two more sectors, IT and real estate, have moved to a mild overweight. So, I mean, honestly, that's a good enough broader, aspect. The second positive, if at all, is the fact that the economy is not like in a very bad shape. Ignore the 8% context of where GDP is because it doesn't feel like an 8% GDP. But if you look at a lot of data points in the near term as well, things have been okay in the economy. Yeah. So we're not falling apart. Remember, this is very different from 2024. We are not collapsing in terms of macro or earnings. We're just in a stable situation. That's basically it. And remember, there's a lot of IPO and fundraising activity this year. Think of it in positive lens. Of course, it does impact valuations for the broader market. but you get a lot of new opportunities to invest in. So if you want to leave on a positive note, perhaps you get a lot more new stocks to assess and invest in this year.
That just sounds like more work to me.
No, absolutely. But yeah, I mean, it's how you frame the question in your head. But, numbers, returns, we will track. And we'll invite you back, Venu, through the course of the year. This is the first conversation of 26, many more to follow. Venu, thank you very much for being here on CNBC-TV18. So that's Venu Gopal Garre of Bernstein with that perspective on markets. But we had HPCL yesterday with us, and we have Oil India today.
Indeed, Oil India is the next management on the show. The stock is down 8% in the last 1 year. In fact, the company had cut down the oil production guidance to 3.55 million tons versus 3.8 million tons in Q2. To discuss this, the impact on the U.S. action on Venezuela, we're now joined by Dr. Ranjit Rat, Chairman and Managing Director at Oil India. He's also the Chairman of the Numaligarh Refinery. Thank you very much. Happy New Year to you, your family, and the entire team. What we'd like to discuss with you is that will more crude supply come to the market post the U.S. action on Venezuela? Just get your thoughts in on what's happened geopolitically, the production targets for FY27, and finally, the crude pricing outlook. But Doctor, just beginning with, what's happened with respect to Venezuela, because you all have a very small, I believe, 3.5% stake in Carabobo project through your subsidiary. Do you all have dividends which are stuck? If yes, can you quantify what is the amount that it's been, stuck in sanctions? And if, indeed, this project now resumes with, U.S. taking over, what would be the new investments you will require? Would you be asked to pay up your share of CAPEX?
Okay. First of all, thank you very much for this longest answer. I will break it into small pieces and then able to answer you. And yes, a happy new year to all of you in the studio and to all your viewers on behalf of Oil India Limited. The first question is the future outlook of crude. Can I take that first or the other one?
No, let's start with Venezuela and your presence there, exposure.
All right. So yes, we have a stake, 3.5% in Carabobo field. The current investment exposure is about $60 million US. And yes, one thing is for sure, while we will wait and watch the developments there, the production possibilities now looks better, and which is good for our investment terms. And should there be a requirement, we would like to enhance our investment because that's what is needed to enhance production from this excellent field that Venezuela is having. The prospects are good. So I am sure it will take some time to stabilize, to kickstart the production or to ramp up the production. So we will wait and watch. And should there be a need, yes, we will invest.
Okay. And when you say your exposure is $60 million in the Carabobo, is that the stock dividends?
No.
Or is the amount that you've invested so far?
Invested so far. Okay. What is required is we have to ramp up the production first. So the current production level is at very low. So we do foresee there is a good opportunity sitting there.
Okay. And are there any stock dividends? Because we understand some of the other, none for you.
Nothing pertains to Oil India Limited.
Got that.
Okay. All right. Hi, Doctor. Good morning. And good to see you, Ben. Let's talk about the operational efficiency then. You drilled around 32 wells in the first half of the year, which is in line with the target. What is the target for the remainder of the year? And how much will you be able to do? Give us your guidance with regard to production targets, both on gas as well as on oil.
Okay. Excellent. I'm glad that you have started the question with drilling, which is closest to my heart. Slight corrections. As we speak, we have already completed 50 plus wells. Okay. And I should be able to explain you a bit. When we say drilling, the drilling component comprises of three parts. One is the rank exploration, which is currently going on in our exploration license fields, which includes our offshore exploration efforts, both in Kerala Konkan and in Andaman shallow water. As far as near field exploration is concerned, that's where we do exploration and exploratory drilling to resurrect or to kind of ensure accrual of additional oil as part of our reserve replacement ratio. As far as development drilling is concerned, that remains our focus in order to enhance our production. Therefore, these 3 buckets of drilling, this year our target is 80. And just to give you a perspective, 3 years ago, we were drilling about 30 to 35 number of total wells. This year, our target is 80. We will definitely cross 70, 75. That's for sure. Because as we speak, we have already completed 50 plus wells. Having done this kind of drilling, we are looking at 2 things. One, we should be able to maintain the production level. But before that, I must tell you, being part of mature fields that we operate on, we encounter a decline of pressure decline rather, which leads to production decline about 10 to 12%. So first is, as part of our reservoir management principle, we undertake very aggressive workover and development drilling, which leads to arrest of these production decline 10%. And on top of it, our guidance this year would be about 2 to 2.5% more. Last year, we did 6.71 million metric ton of oil and oil equivalent, which is both oil and gas included.
Okay.
Highest ever. And this year also, we aim to surpass that number.
Okay, all right. And to split it up, sir, earlier you were talking about oil production, I think 3.55, and gas, I think it was around 3.6. So ballpark, that should be the guidance, right?
That will be the guidance.
Okay.
The best part is we are also looking at cost optimization, which you touched subtly, as part of our efforts to enhance a kind of financial prudence.
Okay. All right. All right. Doctor, just one more point I wanted to ask you with regard to the Numaligarh refinery expansion, the timelines, the expected distillate yield. What is the capex that it's been made? How much more is expected? And how is the ramp up expected on this particular refinery?
Okay, good. I've got a good news to share. This is already a public information. As far as the commissioning of the 9 million ton capacity expansion is concerned, we have kick-started the commissioning on 31st December as promised.
Yes.
That means the mother unit, that is the crude distillation unit, we are already having crude in. Now, as you would appreciate, the entire process of commissioning of all the units will take about 6 to 9 months, and then another 1 quarter or so for stabilization. As far as capex is concerned, we are looking at a total capex of about 40,000 crore, which includes the refinery, 9 million ton complete, the Paradip Numaligarh crude oil pipeline, 1640 kilometer, 1635 kilometer complete, a polypropylene unit, 360 KTPA, juxtaposed to the current refinery expansion complete. So that is the bouquet of investment we are looking at.
Okay. Got that. Dr. Rao, that's very helpful. Good morning, sir. Happy 2026 to you, your team. Prashant here.
Yes, Prashant.
It's fascinating stuff, what you're describing to us. But, we're talking about oil, and you would agree with me, the last 1 year has been about geopolitics and oil, and both are kind of linked at the hip. So can't get away too much. So, my colleague Rima asked you about Venezuela. Let me turn your attention towards the other hotspot, which is, of course, Russia. Has Oil India been able to repatriate some of the stuck dividends from your joint ventures in Russia? Some $300 million in dividends were stuck. Has that come in?
So I'll give you a perspective. As oil and gas operators, we are well prepared for geopolitics. That becomes one of our building blocks of decision making. As far as investments in Russia is concerned, we have got 2 investments. One is Stas Uriac and the other one is Vanker. As far as Stas Uriac is concerned, we have already got 100% dividend out of our investment. Now it's on a self-actualization mode. Vanker, it's about 90% of dividend we have already received. Now, what is struck is the money which we have received, but it is in our account of SBI CIBIL. So we are not worried at all in terms of the value of the money which is there, because it is with us. It's only a matter of time we will figure out how to get this money and then ploy it back in some other overseas investments. So we are not worried at all.
Yeah. So this is basically this is an SBI account, your SBI account in Russia.
Yes.
And it's stuck because of capital controls, SWIFT-related restrictions, etc.
That's okay.
Okay. But it's been about a year now, right? That this is
fine. As far as our capex requirement is concerned for our exploration and development purpose, this money doesn't come to our play. But yes, once we get a clarity on the transaction issues, we will definitely utilize this money for our overseas investment purpose.
Yeah. So the two assets that you mentioned, right? Vankoneft and TAS Yurak. So you own stakes in these assets along with other Indian oil companies.
Correct.
Are you divesting these stakes, sir? Because
no, nothing of that sort right now. It's a India Inc. which is invested, so we don't foresee any divestment as we speak.
Okay. There's no pressure. You've not got any.
No, absolutely
ministry,
not.
Nothing at all. Okay.
Absolutely not.
Are these assets linked to? The other part on the other side, your partners are Rosneft, etc.
Yes.
The reason I'm asking you that, sir, is that the US, I think this was a couple of months back, designated Rosneft and I think one more entity as a specially designated entity, right? I mean,
yeah, absolutely.
Which means anyone doing business with those entities or subsidiaries of those entities can also be sanctioned. So there is that risk.
Absolutely. There is absolute clarity with us. There is no sanction on our operations.
Okay, but that risk has it been? Have you discussed it internally, or it's something?
Prashant, I told you when we go to overseas asset acquisitions, we are well prepared. It's more important that are we prepared? Are we aware of the risks that we are going to encounter? So as long as you are prepared, I don't foresee there is any problem.
Okay, all right. Fair enough. So no plans at all to divest out of these assets. I think so. IOC, Oil India, and BPCL jointly hold 24% in one asset and about 30% in the other asset. In that sense, and you're holding on, and that money is in your account, the dividends, and at some point when these restrictions go away, you'll be able to use it.
Absolutely.
Got that. Just leave us, Dr. Rath, with some perspective on. What will be the production increase that we should expect in FY27, FY28 from Oil India, sir?
See, there are two ways of being an oil operator. I would answer your question in two parts. One, given the fact that we are on an active and aggressive exploration purpose-driven activity now, should there be a discovery, then it's a different. The production enhancement is concerned from our mining lease areas. We do foresee that we will enhance our production. Last year, we did 6.71. This year, we will surpass that. While two parts to that production effort, we will definitely arrest the decline, which we have been successfully doing in last 3 years. So that will be one piece of our effort. The second part is, by virtue of next year, our plan is to drill 100 wells. And we have already created an inventory of 200 plus wells for our next 3 years target. So when you drill as many wells as 80 and 100,
you increase your chances. Yeah.
You are bound to get more production. At the Assam self, there, the place where we are operating, is still have about 30 to 35% of yet to find resources.
Got it.
We are absolutely pretty comfortable as far as our production outlook is concerned.
So just to wrap this interview, and I want to go back to one point about the Numaligarh refinery, and congratulations on the commissioning. So in FY27, what is the expected utilization of the entire expanded capacity, and what can it add to your bottom line? What is the expectation on margins?
Okay. So as far as Numaligarh refinery is concerned, all of you know, last 2 years or so, we have been having 100+% of utilization.
Correct.
This year also, we will be definitely going to have 100% plus capacity utilization. The distillate yield will continue to be 87% plus. The refinery, we will definitely have a good margin. As far as 2027 is concerned, we will not be able to have the full utilization of 9 million ton. That's the process requirement, because first 6 months...
So 40-50%? Is that a fair assumption for the full 9 million tons?
I would look at a number of 40 to 50% capacity utilization, but let's wait for that stabilization process. Because when you migrate from a 3 million ton refinery to 6 million plus to 9 million, 2 trains, and you have to run a crude oil pipeline of 1640. So we would wait. But yes, it's a fair assumption of 40 to 50% capacity utilization.
All right. Dr. Rath, we'll leave it there. Thank you very much. Our first conversation of 2026. I hope we can make it a regular feature through the course of the year to get updates from you, sir. Thank you very much.
Very
really
much.
a pleasure.
Thank you very much.
Okay. We'll take a quick break here. We are back. We focus on the cement sector. Pulkit Patni of Goldman Sachs on the other side. Stay tuned.
Welcome back. Let's focus on the cement sector then ahead of its Q3 earnings season. Goldman Sachs expects the Q3 demand to pick up after a subdued showing in the first half of the fiscal. They remain skeptical though on price hikes due to the capacity coming on stream. To discuss this and more, we have Mr. Pulkit Patni, the India Industrials Analyst at Goldman Sachs, who joins us on the show. Hi Pulkit, good morning and good to see you, Ben. Well, I was going through your note and you're sounding a little bit more optimistic on the volumes front, at least for Q3. That said, getting into Q4, what kind of assumptions you're making, both on the volume parameter front, because there will be that risk, right, of the year-end phenomena of pushing through volumes that will actually weigh on pricing. So your expectations on both volumes and cement prices from here on.
Good morning and thank you for having me. I'll rephrase that a little bit. What we are expecting for the industry is to look at a weak third quarter from a profitability perspective. From a volume perspective, we've been actually positively surprised that what started off as a weak October picked up at the margin in November, and December volumes have turned out to be really strong. So I would expect that momentum to actually continue all the way till the end of the fourth quarter. So we are pretty optimistic that volume from here on should pick up. The other piece that we've touched upon is that we've seen early signs of some attempts of price increases, and we do think that at the early part of fourth quarter, which is now, anytime, we expect price increases to be attempted. To the point that you made, absolutely towards the end of the fourth quarter, given that everybody pushes volume, we do expect some bit of impact on pricing to be negative. Net, we expect a weak third quarter because of prices and a much better fourth quarter supported by both slightly better prices as well as better volumes.
All right, Pulkit got that. Pulkit, in the next couple of years, the EBITDA estimate that you're working with for the industry is expected to improve by around 200-250 rupees per ton. So what are the assumptions you're making both on pricing, volume, and I think input cost or the measures that have been taking where various companies will help in cost saving? So how do you see this 200-250 rupee EBITDA per ton for the industry increase?
Sure. First of all, FY26, we have a pretty favorable base, right? This has not been the best of the year for the cement sector overall, whether it comes to pricing and even volume in the first half of the year. So you're working with a profitability number that's actually itself subdued. Now, when we look at the next couple of years, I'll break it down into two parts. The first part is the first part of the next 2 years, which is the next sort of 6 to 9 months. We do expect a lot of capacity to get added, which will have some negative impact on pricing. And to that extent, we do expect the first half of next year to see some subdued prices. Having said that, I think the bigger picture in cement remains intact, which is one, we expect demand to hover around the 7 to 8% range CAGR over the next couple of years. Secondly, we've spoken about this earlier, but cement is becoming a big boys club. where the larger players are all working towards the cost, which is whether it is converting their power supply to more green power, more waste heat recovery systems, whether it is them working on logistics, converting road to rail, etc., and the overall operating leverage that is going to come because of the size and scale. For the industry, and especially the large players, to get to about 200 rupees EBITDA per ton improvement from here on is something that we think should be relatively easy. What will support in the process is consolidation, and that I think is going to be the additional lever for profitability improvement in the cement sector.
Do you think bulk of consolidation, though, is behind us? I think the top 4-5 players from ballpark around 50-51%, I think they moved to around 65%, early 60%. Bulk of the consolidation, though, is behind us?
Yes, the last 4 years have seen significant consolidation. We could still see more players coming in because ultimately it's cause and action, right? If you see cement companies not taking profitability or adding a lot of supply in the near term, there will be some small players who will feel the heat of profitability, and there could be more coming in. Plus, I think what we have to fully appreciate is that the larger you are, the benefit of scale, size, cost come to you, and which over time will make the smaller players a lot more inefficient, in which case I would say maybe not the same scale, but you'll see consolidation as a theme may continue in this sector for a slightly longer period.
And what's the last accounted number when you talk about the big players holding most of the market?
We'll say we'll probably get to, as an industry, we can get to about close to 65 to 70% just with the larger players.
The top 5 players?
Yes.
How do the return ratios change now, in this sort of a scenario in terms of when pricing is a little bit weakish, the volume push is coming about? When normally you put up a cement capacity, I think the matrix was ROC should be early teens. That number could have dipped a little bit, right? So how has that changed of late?
In a cyclical business, you'll always have periods where when companies are buying capacities, their capital employed goes up, and it takes time for them to improve efficiencies in the acquired capacities. The good news in the sector is that cost of acquisition has gone down from $140, $150 per ton to more like $100, and greenfield capacity expansions are happening anywhere between $60 to $70 a ton. So I would say while ROCs have been subdued in the cement sector for the last few years, we do expect with consolidation, those ROCs should actually start inching up. And somewhere, because the valuation in the sector, while it's corrected, it's still at the higher end of the range, is because market does expect consolidation to bring in better return ratios for the cement players as well. So we would expect, and we do have that in our numbers, that ROCs should trend up as utilizations improve over time.
All right. And geographic preference between the north as well as the south? The last many years, north has been doing much better. But now you have new players that are going out there. The capacity addition as well will be fairly high, while the south has been hovering around lower capacity utilization levels. So what is the preference geographically?
Absolutely. This is something that we have touched upon in our report as well. Yes, that north has been historically one of the best regions to be in. But given that bulk of the capacity addition coming from the large players, including entry by a few smaller players, is all happening in North India, we are looking at almost about 22 million tons of capacity getting just added in North India over the next sort of 18 months, which is why our preference would be for South and West. West as a region seems fairly strong, not much capacity coming in. Demand drivers, particularly real estate in cities like Mumbai, will be strong drivers. So yes, we do believe that North will see capacity utilizations dip down by about 600 basis points, and which could have impact on profitability.
Okay, all right. Final couple of questions then. The long-awaited merger was announced in the Adani Group between both those two entities, though they were almost operating as one. So the synergy benefits could be limited, though the management claims otherwise. Do you believe that this is a big kicker, or this would help them work as one, and ACC, Ambuja, Sanghi, Orient, all of them coming together?
Nigel, while we don't comment on individual stocks, the point that I made that consolidation in the sector will continue, and consolidation comes with its own benefits in terms of, using limestone one versus the other. There are other benefits of brand exchange, etc. So that, I think, as a theme will continue, but I'd not be able to comment on company-specific situation.
Okay, and you would rather stick to the biggest cement player going by your note, right? The big daddy, Ultratech Cement, people thought that the new challengers are coming in there, but the big daddy is your top pick.
Yes, Ultratech is our top pick in the space.
It's been good speaking to you, Pulkit. Thanks a lot for joining in. You've given us a fair idea with regard to how do you see demand, supply, as well as volume trends that will pan out. Appreciate you joining in. Look forward to chatting with you as 2026 does progress.
Thank you for having me.
Well, time to slip into a short break. On the other side, Manisha Gupta will turn the spotlight on the commodity sector. Stay tuned.
Welcome back. It's a flat market that we have on our hands. Nifty Bank, though, is doing better. The Nifty Bank is up 200 points, led by strength in ICICI Bank, Axis and Kotak too, managing to show some grain. Chandan Taparia, Motilal Oswal Financial Services is now joining in to give us some 10 a.m. technical calls. Chandan?
Yeah, good morning, Rima. Thanks for having me. So to start with Nifty, it has been holding the support. So till it holds above 26,100 overall bullish stance could continue, which can take it towards 26,500. Talking about Bank Nifty, declines are being bought with support of 59,750. We are looking for 60,750 to 61,000 marks. Now, looking at the stock ideas, first that is buy on MCX. Major trend of the counter is positive. Longs are intact. Rollovers were better and all set for a consolidation breakout. So one can buy with support of 2210 for an upside target towards 2350. Second trading idea, that is buy on Chola Finance. Most of the financial counters are doing well, and Chola Finance has seen a role reversal. A strong recovery was seen from 1550 and now giving a fresh breakout. So one can buy with support of 1780 for upside target towards 1900. One more trading idea, that is buy on BDL from defense peg. It has bottomed out, negated lower top, lower bottom. So we are recommending to buy with support of 1535, and here target is 1620 marks.
Okay, all right. Those are trades, Chandan. Thank you very much. Good speaking with you, and we'll talk again. Well, let's talk about commodity markets. Manisha is here with, what's top of mind. It's all buzzing, especially base metals, precious metals. Manisha, what are we talking about?
Oh, base metals, absolutely, because that's an area that continues to buzz and very, very strongly. And we're looking at multi-year highs, record highs in many of these commodities. This is what we've done in the overnight markets. And as you can see, it has been a phenomenal move there coming in there. So platinum gained up by 6.5%. Silver was up more than 5%. Copper, record highs, 5% of gains coming in there. And gold prices gained up 2.5% as well. This is what we've done in this year till far. And as you can see, it has been a very bullish, strong start to many of these metal prices therein. So anywhere between 5 to 10% of gains in 2026 so far is what we've done in sense of commodities. Let me remind you that all of these commodities in last 1 year have given you tremendous returns. Platinum has returned 136% on your investment. Silver has gained up by 155%. It has been more than 45% of gains coming in for copper, and gold has gained nearly 70% in last 12 months as well. So strong gains continuing, while it has been about fund buying, fund allocation, and of course tangible commodities doing quite well, speculative bullishness as well. But many of these commodities also have individual fundamentals working for themselves. For copper, we are trading at all-time highs because there is concerns over potential U.S. tariffs that could come in the first quarter of 2026 itself. Apart from that, it also is about strike in Chile's Manto Verde mine, as union members are seeking larger share of profits, with copper prices trading at all-time highs, gaining 45% in last year. This is something that you would perhaps see in various mines where they would want a share of profit with the prices running where they are. Take a look at aluminum then, and the LME prices are trading at a 3-year highs. We're looking at China set to breach 45 million tons of a cap that they had put in 2026. So that tells you that the China production will continue to be curbed. Apart from that, it also is about Indonesia facing higher energy costs, local regulation risk. That is something that has been supportive. We've been talking about lower availability of bauxite, lower ore grades as well. That has been supportive for aluminum. And in any case, you have been looking at key smelters facing issues in various countries like Iceland, Mozambique, Australia, etc., supporting aluminum prices, so much so that investors and bankers have been telling us that number 1 is copper, number 2, absolutely aluminum in your portfolio as a place there. Take a look at the nickel prices. Well, they have been underperformers, but we're looking at prices at a one-year highs for this one as well. This is after Indonesia has proposed a 34% reduction in output in their 2026 budget. So that means lower nickel or lesser nickel availability going forward for this year. Iron ore, which ended 2025 on a weaker note, has started 2026 on a positive note therein. Overnight has been 2% gains, and the markets believe that China's steel makers are restocking ahead of the Lunar New Year holidays in the month of Feb, supporting prices. Zinc should come in on your screens because that one is trading at a 14-month highs. The global inventories are the major reason here, which are at under 2 days of global consumption. Even as we have seen the inventories increase, they're not really much when you look at the demand in front of that. So on December 1st, the inventories were at 52,000 tons. On 2nd of Jan, in a month later, we're looking at 100,000 tons. Even as they have doubled, 104% of an increase there, still at a 2-day of global consumption there. Finally, silver should come in on your screen. 5% of gains in the overnight market, and we're looking at heightening geopolitical tensions, China export restrictions, and then China, remember, produces 60 to 70% of all global refined silver. So whichever way you look at, individual fundamentals, macros, all of that has been quite supportive for precious metals and base metals.
All right, Manisha, thanks very much for that. Absolutely. Starting 26 on a strong note after a super 25. Well, we'll take a break. Lata will connect with Sunil Singhania, founder and a fund manager at Abacus, on what to expect from markets in 2026. That's a conversation you don't want to miss, coming up in just a bit.